Well, welcome to our last session of our Financial Education Summer Series. It's a pleasure to have you here with me. This is week 4, and the topic for today is investing and planning for the future. You know me, I'm Irene Kelly. I'm the Financial Education and Community Engagement Manager at Weave. And today we have a very interesting topic. If you remember on our first session, I mentioned that my background is in financial advising. So investing was very dear to my heart. And with that said, I do want to give a disclosure. We are not going to be providing investment advice today. We're going to be covering the financial basics that we need to know when it comes to investing. Somebody in the chat mentioned that there's an echo. Let me know if you all hear it. Do to my volume here. Okay. So as I said, we're not going to be providing specific investment advice. What we're going to be doing is covering the basics so that each person can apply the basics to your own unique strategy. Okay, so that's what we're going to be doing today. And as you know, it's going to be very important for us to do a mindset checking because investing can be, and thank you, Julissa, for mentioning that there's no echo on your end. Nicole, it might be something with your computer. Thank you for helping out, ladies. So here, everybody, I would love for you to situate the chat because I would like to ask you a question. And the other thing I want to mention is if you have a question as we go along, please feel free to write it down and we'll get to it at the end of the session. And with that said, the first piece I would like to focus on is this idea of where is our mindset when it comes to the world of investing and planning for the future. So this prompts me to just ask you a question. So here, let's just take a moment, right? And when you hear the word investments, what comes to mind? And if you could share words that come to mind, feelings that come to you, that's going to be very helpful. When I've done this exercise in the past, some things that come up is future, gains, risk, right? Uncertainty, gains. Yes, thank you for sharing. Interest, multiplying income. Yes, that's exactly right. So it's important for us to, yes, and thank you for sharing. Also confusing, right? It's for other people. Thank you, Melissa, for sharing that. So it's going to be very important for us to address what we have in our baggage when it comes to our financial mindset around the world of investing, because investing doesn't have to be confusing. It's important for us to come to this realization that we're not alone in this industry, right? It's like when something hurts and we go to the doctor, right? We don't know all the lingo. That's why we go to a professional. Something similar happens to investing. It's important for us to know the basics, but then we can work to partner with a financial professional that can help us understand everything with a little more, with a deeper level, right? And somebody that makes us feel comfortable when it comes to asking questions, because in the world of investing, it's a world that is always changing. So with that said, it's going to be important for us to acknowledge that we're always going to have questions, and that's part of the journey. So I'm hoping that today I can make this a little more fun and make it a little less confusing, because it is sometimes a confusing topic, especially because a lot of people use this lingo that we're like, well, what does that mean, right? So it's important for us to feel comfortable asking questions. Just like when we go to a professional, a doctor, a lawyer, and we don't understand the lingo, let's be patient with ourselves. Let's start thinking about what's important to us, right? Our vision, and connect our investments to that vision, right? Investing, for the purpose of our session today, we're not going to be focusing on investing as when we hear, oh, you have to invest in this company, right? Or what's trending. And then the moment you go up in value, you sell. That's not what this session is about. When we're talking about investing here, we're talking about investing for the long term, right? We're talking about investing so that we can multiply our money, grow our money through interest, and have something for the future, right? And utilize investment tools to achieve our goals. That's how we're going to be talking about investing today. So when you hear me talking about investing, basically what we're talking about is when we acquire something. This could be real estate, this could be currency, stocks, bonds. We're going to talk about them in a moment, so that their value increases over time and we can see a return on that investment. The goal of any investment is for it to increase over time. So today we're going to be talking about the nuances of what happens, right? Because not every time we see an increase. Sometimes we see some fluctuation, and that's why we need a strategy. So that's why we're going to be talking. That's the approach that we're going to take when it comes to investing. And thank you to everyone that shared in the chat what comes to you when you think of investing. So along these lines of investing for the future, I would love to share with you one of my favorite investment related quotes. And this is from Warren Buffett. And he says, "Someone is sitting in the shade today because someone else planted a tree a long time ago." That's what investing for the long term means to me, to him, to a lot of people. It's planning for the future, right? It might not feel that good right now because we're making sacrifices, but it's about creating that tree for the long term, right? It's about thinking ahead. It's about legacy sometimes as well. So that's why we're going to be focusing on that approach to the world of investing. And I would definitely encourage you to learn a little bit more about Warren Buffett. Warren Buffett is a leader in the world of business and investments. He's also known as the Oracle of Omaha. That's his hometown. And one of the reasons why I like sharing just his vision and his approach to finances is because when he talks about investing, he doesn't focus on trends. He focuses on quality. He focuses on good management and also that idea of a good investment for the long haul, which is something that I have always recommended my clients to think about when it comes to investing. So with that said, let's start talking about different types of investments. On our last session, we talked about interest, and we focused on when interest is against us, right? We have to be strategic when when it comes to debt. And today we're going to flip that coin, because today we're going to focus on what about when interest works for you. So when interest works for you, when your money starts multiplying and growing, what are some vehicles for us to get there? So today there's 3 types of investments that I want to first touch on. So the first is investments where we own an asset, right? This could be owning shares in a company. This could be owning real estate. This could be also owning a business. So this is when we own something. Another type of investment is when we lend our money, right? So when we lend our money, that we will be talking about bonds. We're going to dive deeper into them in a moment. We also mean certificates of deposits. We also mean literally lending our money to someone, right? Saying, okay, I'm going to lend you this money with this percentage of interest. And then there's also alternative investments. We're not going to spend a lot of time talking about alternative investments, but in this category, we would have precious metals, we would have raw materials, we would have commodities, which are basically raw materials that can be bought and sold without holding the raw material yourself, right? So you don't need the physical product. And they're mainly grouped into 3 groups: energy, oil, natural gas, etc., metals, copper, aluminum, etc., and agriculture. So we're not going to be focusing on those for today. Cryptocurrencies are also an alternative investment. They tend to have these alternative investments tend to have a little more risk. So we're going to be focusing on the first 2 for today's session. So let's dive a little deeper, shall we? So when it comes to these types of investments, and I just noticed, I apologize, types of investments. So the first type is what we were talking about. Okay, when we lend our money. When we lend our money, this is also in the investment world called fixed income. Why? Because we know, okay, this is the exact amount that I'm providing you. This is the interest rate that we're going to work with, and everything is fixed. So that's these types of investments. When we're talking about our investment portfolio, right? All of our investments, these investments are a very good cushion because they provide more certainty for our portfolio. So it's very good to always have a mix of investments, right? So fixed income would be how we call them. And in this category, we have certificates of deposits, which are among the safest investments. They tend to be insured, which is a really good thing. And they are also good for short-term goals, right? Short-term goals. Certificates of deposits are good for short-term goals. Then we also have government bonds. So a bond literally becomes this contract where you become the lender for a government or for a corporation. And it's also a fixed income investment, right? We know this amount is what I'm giving you at this interest rate. This is when you give me my money back. So that's kind of like the big picture of these items. And it's important for us to remember, right? This is a marathon, not a sprint. And we're always going to continue learning. And it's important for us to ask questions. So the other piece now, it's getting more popular, it's called crowd lending, which is when you can lend money to other people that you might not know, or you can lend money to businesses. So that's what crowd lending is. There's a platform called Kiva. I just wrote it in the chat. And through Kiva, if you say, I would like to lend my money to other people, that's when you can go into a crowd lending platform and provide loans to other individuals, which is also a good type of investment if you like that space. And then business, that's when you basically lend your money to a business, or you lend your money to your business. And so that's when we lend our money. Then we have investments where we own an asset, right? Real estate, it's a perfect example of owning an asset. And when it comes to owning an asset, and we connect this with last week's topic, debt or the debt that we incur to buy these properties are generally used to subsidize the cost, right? So it's important to know that it's okay to have some debt, and that debt is considered an investment, right? Because you are buying a property that it's going to increase in value. So it's a good investment. That's good debt. We talked about it last week. And the other thing to consider is that these investments tend to have a simple interest rate, which is good because we don't want the compound interest rate. That one is dangerous. We want simple interest rate, crystal clear. This is how much I'm going to pay in interest. So this is one of the types of investments where you own an asset. And here I'm going to dive a little deeper into shares, right? And into understanding a little better how do the stock market truly works, and what do we need to know before investing. So, and here, if any question, remember, if you have any questions, just write them down in the chat or in the Q&A and we'll get to them. So here, the same thing happened. Okay, types of investments where we own an asset, but it's an asset that we own through the stock market. So what are these types of investments? Basically, when we invest in something like shares, right? We are giving our money to a company. We are saying, okay, I'm going to become part owner, little, right? But it's part owner of that company. And we are invested in them as a company. We're invested, we really want them to grow. We want them to increase their value. So we can buy stocks in two different ways. We can buy them individually, or we can buy them as a packaged product. So for stocks, we can earn money in two ways. The first way is called capital gains. So that means that the value of your share increases. When you sell it, that's what you get. You get a capital gain. If you sell your investment and the investment was less, it had less value than when you purchased it, then we call that a capital loss. Capital gain, capital loss. Here, one thing that I want to mention, I saw several times working with clients that when you own shares, it's tricky. We have to be very clear about why are we investing? Because when you're investing for the long term, you're not looking at the value of your investments every day. If you do that, that can generate anxiety because investments tend to fluctuate in value. the business or the company that you invested in, it's going to fluctuate in value every day, minute by minute. So that's why we recommend connecting what you're investing on with a goal and being very careful with the term, right? Like, what do I mean by that? Knowing, okay, I'm not gonna need this money until this year. So we know how much time we have to be part of that volatility, that those ups and downs in value, and knowing when we need to decrease some of that risk so that our money is safer. And that's part of the strategy. So capital gains, one thing that it's going to be important to recognize is if you, and this is one way to look at it, if you live in your home and the real estate market is not doing well and your home loses value, but you love your home and you're not planning on moving, are you going to care about that drop in value of your home? And most likely the answer is, no. If I'm planning on staying there and living there for the long haul, I don't really care about a drop in value. Same principle should apply with something like our stocks, because our stocks are going to come down in value sometimes, and it's not considered a loss until you sell it, right? We don't call it capital gains or capital losses until we sell. If we don't sell, the loss is not real yet. It's just in paper. So that's one thing to be conscious of when it comes to investing, being careful, being mindful of starting to connect. Why am I investing? What is this goal for? When am I going to need this money? Then the other way in which we can earn money with stocks is through dividends. So some companies, especially more mature companies, like for example, McDonald's, Wells Fargo, these companies that have been around for a long time, what they do is when they receive their earnings, they want to share those earnings with their shareholders. So they send some of these gains to shareholders through something we call dividends. So these are the two ways in which we can gain some money. We can see that return on the investment through stocks. Now, the issue here with stocks is that some stocks are actually very expensive. Like for example, a few weeks ago, this price is from June 16. And a share in Amazon was $3,503. One share in Amazon. One share in Google was $2,442. If we want to diversify, if we want to take advantage of the opportunities in more than one company, buying individual stocks might not be a good option. And that's when this other investment vehicle called packaged products comes in. So when you invest in a packaged product, you're basically investing in a greater variety of companies and financial products. So your money is combined with the money of other investors in order to buy more stocks and diversify your portfolio better. So imagine rather than buying one stock at a time, it's going to be more affordable to just buy shares into a packaged product, which is like, imagine a big pie with a lot of different companies in it. That's what a packaged product is. So there's two flavors generally, right? We're looking at the macro perspective here. Mutual funds. Mutual funds are managed by human beings. So they charge a little extra for that management. And the other flavor would be exchange traded funds or index funds that are based on algorithms, right? So there's not a lot of active human management. It's more about computer algorithms, and they are a little more affordable. They don't have that higher commission that some mutual funds have. And why is a packaged product helpful? Just an example. The S&P 500, right? We've heard the S&P 500 is basically the top, when we're talking, it's the 500 largest companies listed in the stock exchange in the United States. So there are index funds that follow the S&P 500. So that carry stocks of all of those 500 large companies, and one share in one of those funds could cost you $340. Very different, right? And that through something like that, you could get access to companies like Apple, Microsoft, Amazon, Facebook, Google. So you see where I'm going, right? It's important for us to diversify the way in which we invest as well and think about what works better for me And that's the approach that we take. So these are the options that I wanted to start sharing with you. So once we know, okay, what's the advantage of, truly, it depends on your strategy, it depends on your goals. Sometimes people like to own individual stocks, particularly in companies that they truly like. It's okay to have some individual stocks, but we really recommend that to diversify. It's worth looking into packaged products so that we can have access to more companies with less money, right? So it's a good deal. And in terms of packaged products, the other thing about them is there are so many varieties of packaged products. There are some of them are specific to industries. Some of them are specific to certain standards. Like, for example, there's some packaged products that are environmentally friendly. There are some packaged products that just invest in renewable energy. And they are, there's also investment funds or packaged products that invest, for example, in women-run companies or companies that have women in leadership positions. So there's plenty of options when it comes to packaged products. That's why we should start with this idea of, why am I investing? Because your why should direct the strategy. Your why should lead you to identify what are the best investment options for you. So we're going to be diving a little deeper in regards to that piece of the strategy. Okay. And with that said, I want to spend a little bit of time talking about the stock market, because a lot of people say, okay, I like that, but how do I start? And we hear a lot about the stock market, and we hear a lot about the financial industry and how, unfortunately, the financial industry has had its instances where quality was not being sold, where a lot of people lost a lot of money just because the industry was not properly regulated. So it's important for us to acknowledge that the industry has changed and the industry is going to continue to change. That's why we recommend having a financial team around you that can help you not only answer those questions, but also oversee your investments, so that when something loses quality, you can get a call. When something loses quality, you get an email, depending on how you invest, where you invest. So this is a picture. Some people say, okay, I've never been in the stock market. How does that look? This is a picture of the New York Stock Exchange. The New York Stock Exchange, or the NYSE, also known as NYSE, was founded in 1792 and is the largest and most active stock market in the world. So basically, a stock market, it's a market like when we go buy fruits and veggies. The difference is that what's being sold here is securities and investment products. And we call the sellers of these products, we call them stockbrokers and traders. And you can buy and sell securities such as shares, bonds, etc. And a long time ago, these investments were granted on paper. So you needed, if you bought a share in Ford, you needed your paper saying, this is my share in Ford. Nowadays, most transactions are digital. And nowadays, there are a lot of platforms that can help you like invest on your own. You don't even need to talk to another human being if you want to invest. So it's important also to acknowledge, what do we like, right? Do we want to have like a human next to us helping us make those decisions, or do we want to try to automate it, do it online? Nowadays, there's also this concept called a robo-advisor, where through a platform, you can just be matched with a robo-advisor that helps you based on your goals, helps you develop a portfolio and pick some of these investments. So there are plenty of options when it comes to investing. So that's when I recommend, let's go back to basics. Let's identify, why are you investing? What are your priorities and what are your goals? Because again, our goals should dictate how we invest, what we invest in. And also our values as a human being. I believe it's important to consider that, because when you're investing in a company, you're investing in what the company does, the impact the company has, the management of that company. So I believe it's important to think about what we are investing on and ask questions. So another thing I want to mention here is nobody has a glass ball, right? Whoever guarantees you something in the stock market or promises irreal returns, watch out. Watch out, be careful. Because the stock market, as we've seen historically, it's not something that we can predict, right? Sometimes we can predict, okay, this company is going to do well, it has good quality management, but we don't know the exact numbers of the value and how much of a return you're going to get. So be very careful when people make a big hype out of something. Be careful, right? Just, it's important to ask, right? Okay, let's evaluate the quality, the management of the company, and also the risk. Because when it comes to investing, everybody's different. Everybody's willing to take certain risks and not take certain risks. That's why it's important to combine what you invest in with your tolerance to risk. That's another very, very important aspect. So here, I would like for us to use a chat. Remember when we talked about financial vision? Remember those words that we chose about how we want to feel when it comes to our finances. Let's take a moment to remember those words, to bring them back. If you want to share them in the chat, that would be wonderful so that we can all remember what words came up. Some great words came up: free, empowered, motivated, right? I remember someone said free, which I loved. I think that one's a good one. So secure. Thank you, Maribel, for sharing. Let's reconnect with those words, because those words are going to be very helpful when we're picking investments, very helpful when we're starting to invest for one of our goals. And whatever decision you make, if it's not getting you close to that word you picked, we need to take action, right? We need to ask, we need to say, hey, this is how I'm feeling. What changes can I make? Yes, thank you so much for sharing. Confident, worry-free. Oh, I love that one. Yes. So that's why it's going to be very valuable to reconnect with that word. And when you're working with a financial professional, and we're going to talk about what type of financial professionals we can choose when it comes to investing. But that word should be a regular part of your conversation with your financial professionals. Hey, this is how I want to feel. This is my priority. And this portfolio you helped me pick, I'm not feeling it, right? Let's make changes. Let's increase the quality. Let's take less risks. So that word is going to be very helpful when it comes to understanding what we need to tweak. Okay, thank you for sharing. Now, once we know, okay, this is where we invest. This is where we start getting our stocks, getting our packaged products. So how? Right now, the question becomes, how do we invest in a way that it's strategic, in a way that it's considering the risks that are just part of the game, right? Risk is a part of investing, yes or yes. So the key here is to choosing wisely what risks we are willing to take. Oh, don't you worry, Melissa, we're going to send the recording. That's why we record each session. If anybody has something coming up, we'll send the recording tomorrow. Thank you for letting us know, Melissa, or letting me know in the chat. So going back to the how, okay? I love this graph that I'm sharing with you because it truly talks about one of the first most important golden rules of investing, which is diversifying. Diversifying is the process of spreading our investments into a variety of assets to avoid taking too much risk. So here in this graph, we can see in the bottom line, we go from lower amount of risk to higher amount of risk. And here we can see in our vertical line, we can see the lower, the kind of this piece closer to our risk, it's about a lower potential return. And as we go higher, as we go up, that's a higher amount of potential return. So when it comes to the types of investments we've talked about, we can start with a lower amount of risk and return. We have cash, right? When cash is just sitting, sometimes in a savings account, generating a little bit of interest. That is not, we're not putting our money at risk. Here, the key is to consider this is a good space for short-term goals, right? Goals that, okay, I'm going to need this money in 3 years. Then let's stay right here in this piece, right? With cash and fixed interest. If we have more time and we're like, well, I'm not going to need to touch that investment in 5-10 years, that's when we can go up in the risk scale. So first we have cash, right? We mentioned that. Then we have fixed interest, like when we talked about bonds, certificates of deposit, etc., where we have a little more return and still we don't have as much risk. Then we start getting into property, where we have way higher rate of return and a little bit more risk. Then we start talking about shares, right? Being part owner of a company, of a publicly traded company. That's when you can see this is higher rate of return, but it's also a higher amount of risk. And then we have alternative investments like what we talked about, cryptocurrencies, commodities, metals, etc. A lot of risk, right? A lot of risk, a lot of potential return, but a lot of risk. So here, that's where we encourage people to just kind of bring awareness to what type of risk you're willing to take. And a lot of investment companies, what they do is they have risk tolerance questionnaires that you fill out before proceeding to invest your money. So that's how they match you with certain investments that are a better fit for your tolerance to risk. So that would be the flow that we would recommend people to look into when it comes to their options. And when we talk about diversifying, that's when I recommend a little bit of everything. A little bit of everything is going to help you really achieve this process of diversifying your portfolio, right? And when we mean portfolio, we mean all your investments together, right? That's your portfolio. So a little bit of fixed interest, a little bit of shares. If you were buying a property, that's wonderful. So make sure that you mix, right? Especially for when we're talking about retirement, when we're talking about longer term goals, it's also a good idea to do these checkups of your portfolio. We recommend doing quarterly checkups. I think quarterly checkups are very healthy because they always give you that peace of mind. Okay, my investments are good. Oh, maybe I need to switch this and that. That company I invested on is not doing well. And my advisor recommended switching for a different one. So that's why quarterly checkups are very healthy. Daily checkups, I don't recommend, because daily checkups, again, if we don't need the money and we see a lot of fluctuation, that alone can generate a little bit of anxiety. So be mindful of what works for you. Be mindful of what gets you closer to that vision you shared today and that you've been sharing all along this series. So that's what leads us. Diversification is important because it leads us to that return on investment, a return that it's a healthier return because we're not taking way too much risk. And it's a realistic rate of return as well. And when people talk about, you're going to hear your ROI, that's your return on investment. And that's the key measure we use to evaluate the financial performance of an investment. So your ROI. And I like to use the ROI for other things as well, right? Like when you're investing your money, when you're investing your time in something and you're getting some good feedback, you're being rewarded for spending time doing something or increasing your professional development, learning things about something new you want to work on, you're investing your time. And if you can do something with what you learned, do something with that new skills that you acquired, you're getting a return on that investment. So the concept of return on investment applies to other things, not only to investments in the financial space. So I like to use it in other aspects as well. And another thing to know is that the result is often expressed as a percentage. So when you do your financial checkups or your portfolio checkups, you're going to see that as a percentage. And again, how much we invest in each of the categories will depend on your unique financial vision and goals. The shorter term the goal is, the more we recommend to have in fixed interest and cash. The longer the term, that's when we have room to wiggle. Like we can say, okay, I'm not going to use this money in 30 years. Then you can afford to have 80% shares, 20% fixed income, right? But again, this depends on you and your unique financial vision and goals, which is why through our session, we worked on our financial goals, right? It is going to be recommended to check your progress, achievements, and obstacles at least once a month, your progress towards your financial goals. And another thing is to consider that these goals are going to change. That's why we encourage you to, okay, go through your goal sheet and review it next month and see what has changed, right? Ultimately, our goals are the foundation of our financial life because they give us clarity, they give us direction, they help us determine where we are going, and they help us make the process of reviewing our numbers so much more meaningful because they are taking us somewhere. So that's why I'm definitely encouraging you to take care of those financial goals. Make sure that you review these financial goals. And I hear you. I hear you, Karen. Karen shared something with me through the chat that not many Americans can afford stocks right now. And that's absolutely true. The thing is that if we start saving, right, the concept of investing, it's important for us to know that it's there as an option, right? To know that it's there, because once we start with, okay, first, let's take care of priorities now, which priorities means emergency savings, right? Once we take care of that, we can slowly grow towards this space of maybe investing in stocks can help me to get to my goals, right? And then, okay, and I'm getting some very good questions and I'm going to get to them in a minute. So I just want to invite you to, if you are interested, okay, I would like to invest in something. I would like to connect some of my goals with investing. That's why I'm giving you these options, right? Because it's important for us to know that the options are there for when we are ready to take advantage of these options. And another big piece is to consider where to invest, right? Because depending on our goals, there are vehicles that are much better for investing. Like, for example, we always talk about the general investment accounts, right? If you invest in a conventional investment account, you're going to be able to take your money out anytime you want. You're going to be able to sell your investment anytime you want. But if you have an education goal, right? If you want to help your kids go to college, if you want to eventually, you are saving for your own education. There are education accounts that focus on investing your money so that when you're ready to take that money out for education, you don't pay taxes on those gains as long as you use them for education. Normally, there is a tax. It varies from state to state, but there is a tax every time we get capital gains on our investments, except for when we invest in education. If you invest in an education account, those gains, as long as you use them for education, you're not going to be taxed on those gains. So that's why it's also important to connect with the goal, because there are investment vehicles out there that are friendlier depending on our goals. And when we talk about retirement, for example, there are so many options to invest for retirement. And sometimes you can start with $10, $20 a month, right? We don't have to start very, very big. We can start very, very small as well, which is also valid. And it's a good strategy to pursue because your money is going to start growing over time. And some options for this, and we're going to be talking more through we're going to be talking more about this space, so more to come. But some options that I wanted to share with you today is an individual retirement account, your IRA, right? A Roth IRA. Roth IRAs are a little more flexible because usually when you invest for retirement, if you take the money out before usually it's about 62, 63. If you take the money out before, you're penalized. Except for a Roth IRA account, you can take the money you've contributed, not the gains, what you've contributed, you can take that money out at any time. And the other piece about a Roth IRA is that you're allowed to take up to $10,000 for the purchase of your first home. And that can include gains as well. So some of these vehicles can be flexible and can allow us to get closer to our goals without having to invest a lot of our money. We can start small, right? We can start small. And that's what we recommend, right? Little by little, like we talked about that on last session when we were talking about managing debt, right? Little by little, step by step. Just look at your budget and see if it's feasible now. How much can you allocate for one of your goals that is long-term? If it's not feasible now, we know that this is an option if we want to take advantage of this option. Then, some golden rules about investing. First, align your investments with your priorities and values. Consider short-term versus long-term strategies, right? Long-term, we can take more risk. Short-term, let's stay safe, right? Let's stay safe. Then the other, diversify. Don't put all of your eggs in one basket. Make sure that you are putting your eggs in different baskets. And this applies also when we're thinking about, and going back to that topic, right? We were talking about, hey, if I cannot afford stocks, we could apply these principles to other types of investments, like when we're investing our time. I really like making that analogy, because when we're investing our time, especially when we're generating income, we recommend diversifying your income sources. That's diversifying can be very helpful when it comes to planning for the future, because putting all your eggs in one basket can be too risky sometimes. So another thing is choosing quality. Always choose quality, right? Sometimes there are trends and there's people that are going to be like, oh no, invest in this. If the quality is not good, be careful. Be careful with where you put your money. And also lean on your financial team, right? And avoid unnecessary risks, because ultimately the amount of risk you take affect how you feel about your finances and affect how close you feel to that vision. Mm-hmm. And somebody asks, do you recommend getting out of credit card debt before investing? Yes, I absolutely recommend. First things first, and especially credit card debt, because credit card debt has such a huge interest rate, right? Unfortunately. So let's make sure that we play the interest game right, and let's pay credit card debt first before investing, because all that interest in your credit card is ultimately taking, really kind of demolishing the interest that you're getting, or the return on investment that you're getting through your investments. So I do recommend get out of credit card debt before, and have these as a future plan. Have these as an option that you can get into once you take care of priorities, which is very, very important. Or another thing is if you get, for example, when we get a tax return, that's when it's good to think about investing, right? So that's why it's very important to be informed. That's why we're offering this financial education summer series. We want to make sure that you're informed about how the industry works. Even if we're not ready to proceed now, especially after COVID, I know that this can be a very tricky topic to talk about, but we are talking about it because some of you might have a little IRA that was created through one of your previous jobs that you never touched, and it's there, and we don't even know what to do with it. So at least now we know the basics. So when we have a deeper conversation about what can I do with this, we know the options. Mm-hmm. So here, let me take a pause to look at the Q&A. So Amy, thank you for your question. Do you have an opinion on using companies like Acorns to start somewhere with limited savings? Yes, I think companies like Acorns, and to give some perspective, Acorns is a company where when they connect the platform with your debit card, every time you spend money on it, they round up, and that money that they rounded up, they invest for you, and you choose what you want to invest it on. The tricky thing with companies like Acorns is the commissions they charge. Just being aware of how much they charge, and if we're okay with it, proceed, because they make it very easy for us to invest with little. Because that's the key with investing. Investing is not about, oh, I invested $40,000 in one chunk on this. No, we actually recommend investing little by little, right? Because over time, if we're buying the same products, the price per unit or the price per share is going to be cheaper if we buy little by little, but discipline, right? Little by little. So that's what we had seen before. So I hope that I answered that question. I'm going to write Acorns right here. It's another platform that someone brought up Amy brought up in the chat. So thank you, Amy, for that very good question. Then somebody asked, what's your take on cryptocurrency? Ooh, that's a whole other webinar right there. But to summarize, cryptocurrency, it's risky, right? It's a good strategy to diversify your portfolio, because it's something that I believe it's here to stay. Yes, a lot of regulation is needed. Mm-hmm. So that's why there is a lot of risk around this type of investment. So I wouldn't recommend starting with that type of investment. Absolutely not. I would recommend it as part of your overall portfolio if that's something you're interested on. If you're not interested on, Focus on what you are interested on and what you understand, right? And Bitcoin, it's an example of a cryptocurrency. Thank you, Aiden. So I would say just be careful, cautious, right? Just those type of investments, as I showed you in that graph, they are among the riskiest of the investment in the investment category. So just be mindful of the ups and downs that you're going to experience investing in these types of vehicles. So just be cautious. That's the only thing, caveat I want to provide. And we can go deeper into the cryptocurrency conversation. I actually find that the cryptocurrency is very interesting. I do think that it could be a good strategy. It's particularly thinking future, right? How are our economies, how are they going to work, right? So that's why it's a good, but be careful. And here, it's important to consider risk, right? And financial risks go way beyond this aspect of investing. Financial risks are always present. We just saw it. We just saw it going out and continue, still not fully out of a pandemic, right? Our finances are always in this fragile state. That's why it's important that we plan for the future. And we just, as we have talked about in the financial mindset piece, name it to tame it. So we're going to take a little bit of time to name some of the biggest risks that can affect our finances. Risk one, job loss. What we recommend in terms of planning ahead or preparing for the unexpected. And this, again, remember that we talked about being proactive. When we look at our finances, as we did for the summer series, it's about looking at them from the perspective of being a financial advisor. We're not going to judge. We're just going to be very proactive and very strategic. So with that said, let's keep going down the list. So job loss. What do we recommend? Save and reserve 3 to 6 months of cash expenses, right? Of what are your monthly expenses to just be comfortable. That multiplied for times 3, we usually recommend times 6, because the data when financial advisors started saying save and reserve for 3 to 6 months, that was because over 10 years ago, that was the average time that someone took to find a new job. We live in a different world right now. So it might take some people, depending on your industry, it might take you way longer to find a job, or it might take you 1 week. It depends on the nature of your work. So be mindful of that. Think about your industry. Think about how much time would it take me to find a different job. And that's why it's important to have a reserve. And also this reserve, as you see, it's almost in every category, because the reserve is going to save us from so many other risks as well. So also have an accessible and available line of credit. It's a line of credit, or is that credit card that you kind of use for decoration. You never use it, and you just have it there for or in case of an emergency. And so, Cristina, thank you so much for sharing. I've been looking for a new job since January, so definitely recommend 6-month reserve. Amen. That's exactly why it's important to have these conversations, because back in the day we used to say, oh yeah, 3 months, right? But nowadays I don't think 3 months is going to cut it. So be mindful of that. Now, another risk number 2, death or disability. So for this particular risk, again, save and reserve 3 to 6 months of cash expenses. Another thing, you can prepay funeral expenses, which is a very helpful strategy that can ease a lot of that anxiety, right? For a lot of people that experience, hey, my family had issues when a loved one passed away that didn't have any money, didn't leave anything to us. Imagine what you're leaving behind when you're gone. That's why prepaying for funeral expenses can be a good strategy. And also making sure, and this is so important, make sure that you have a will in place and that you're in communication at a couple level, family level, so that everyone knows what to do in case of an emergency. If you don't have a will, I want to share with you, there's a nonprofit organization that can help you create your will online, very simple, and it's a free service. So I'm in court, and it counts as a will. So I just dropped it in the chat. It's called 5wishes.org. Highly recommend 5wishes.org. So another key risk, health problems. So for health problems, depending, right, on what we can do, insurance is ideal. But if that is not possible, save and reserve 3 to 6 months of cash expenses. And then the last piece in terms of risks that can affect our financial life is stock market losses. That's why we recommend, as I shared before, diversify your portfolio, have low risk investments there as well to provide that cushion for the riskier investments. Have a long-term strategy, not like, oh, I'm going to buy this and I'm going to sell it tomorrow. That's a risky game to play, right? So let's be conscious of that. And then the other piece is have investment checkups. Quarterly checkups we recommend and this is about your investments. And those checkups are key to make sure that the quality of your investments has not changed, make sure that you still feel comfortable with how much risk you're taking, and that your portfolio continues to align with what you want, what goals you're pursuing, and who you are as an individual, which is very important to make sure that your values are translated into your investments. So in here, remember, we must focus on what we can control, right? So there's so many things that we're not going to be able to control, right? Change of regulations, politics, natural disasters, et cetera, et cetera. The list goes long. So the key for us to be proactive and strategic is to focus only on what we can control, which is this portion on the right. How can we prepare? How can we plan for the unexpected? And be patient with yourselves, because sometimes we are not close to getting to these pieces, but knowing that that's my next step is very helpful because it provides us that direction that it's very important. And that part of that piece is having a financial plan. And your financial plan is composed with your goals, right? What do you want? And you worked on that. You have that kind of that background that we worked on session 1 on. Then what do I have? That was homework from last session, your balance sheet, having clarity on, okay, how much do I own versus how much do I owe? That's part of your financial plan. And your budget, right? How are you going to reach your financial goals? So those 3 pieces are basically a financial plan. So if you've been able to do all of your homework, let me tell you, you're there, right? Then the next piece is, how am I going to build a financial team around me to continue managing this financial plan? So your balance sheet was part of this plan. I recommend checking it at least every 6 months. And we must make sure that we have our goals as categories, right? And somebody shared this beautiful feedback of name your category, something that excites you, motivates you. That's also healthy. That's also a good exercise to work on. And the good thing also about the balance sheet is that it helps you identify where you're at and how you're doing with your financial goals. It gives you that clarity, and it also tells you if you see things you don't like, you know what to work on. That's a meaningful piece of this exercise. And then the other piece is your budget or spending and savings plan. I recommend to check your budget once a month at least, and make sure again to add your goals as categories, right? Your goals should be categories there, even if it's, I just have $1 to put in that goal. The exercise of doing it, that habit, it's very powerful because it's also connected to that mindset, and it's also leading you to these habits so that when you are capturing additional sources of income, when you think about, oh, this other opportunity, oh, I'm going to make this product and sell this product, I'm going to pursue these other income generating ideas, you're going to know what to do with that money. Rather than spending it in other things, you're going to know what to do with it because it's already part of your budget. And it's also helpful because it helps you plan on how are you going to get organized, how are you going to organize your money. And when it comes to a couple, when it comes to a family, it helps you generate agreements, right? It helps you have a healthier relationship with your money, not only on a personal level, but also at a couple's level, at a family level. I think of a budget as a map. And like any map, the destination, we can have little turns here, unexpected turns, unexpected obstacles, but we do have that map that gives us that peace of mind that, okay, at least I know a little bit of where I'm going, how am I going to get there? So that's why it's important. So we're not in the dark when it comes to our finances. And the next piece is aligning these 3 documents to make sure that what you want is translated into the 3 documents. And the good news is that you're not alone in this path, right? Financial empowerment, that process of combining what we want with our mindset, with the financial basics we need, that process, it's a journey, right? And you're not alone in this journey. So here, I want to go back to that traveling analogy. If you're in the driver's seat, you can choose Copilot, you can choose people to sit in the back to give you some good feedback, and you're the one that chooses those professionals, which we like to call your financial team. Your financial team can start with your banker, wherever you save, right? Develop a relationship with that banker. Ask your banker questions, right? Ask your banker, okay, what savings account gives me more interest, right? And ask for those options. Then another piece, when it comes to investing, that's when we can work with a financial advisor. We can also work with a financial coach. They're different professionals. We can also work with an accountant when it comes to really kind of what am I going to do with my money, with my tax returns, etc. We can work with registered agents. Basically, registered agents are similar to an accountant. They perform bookkeeping options. The difference is that they're allowed, in the eyes of their IRS, they are allowed to represent you if you have any issues when it comes to your taxes. So that's some of the difference. And we are going to have part of our financial empowerment program is to have monthly programs, monthly webinars / meetings. We're going to have them as meetings moving forward so we can all see each other and ask more questions, where we're going to talk to different professionals like the ones listed here so that we can learn more about how they work, what they do. So another example, real estate agents, mortgage consultants, lawyers, they can be part of your financial team. And also we are here for you. So here, I just want to quickly ask you a question. What qualities should we look for in the financial professional we work with? Just whatever came to mind. And that's somebody asked me, how do we find a financial coach and advisor? So there, you can start with a very simple Google search, right? Financial advisors in my area. You can start looking for companies first and see what companies you like most. And it's important to know that, for example, financial advisors, sometimes they charge, or financial professionals can charge for their time, or they can charge a portion of your investment. So you decide what you feel more comfortable with. So it's also doing this exercise. Okay, what am I going to feel comfortable with? But a lot of professionals charge by the hour. A lot of other professionals, they just, like a banker doesn't charge you by the hour, right? Bankers get money from the product that they sell you and from commissions based on your accounts. So similar topic with financial advisors. And thank you so much for sharing what we are looking for in financial professionals: honesty, integrity, knowledge, ethics. Yes, absolutely. That's what we need to look for. And Jenna, thank you for being here. Thank you. Thank you. And another quality, trust. Yes. And the reason why I asked this is because we actually recommend that you interview different professionals, right? Take your time. Just like when we're going to buy something we really like, when we're going to buy a car, we don't buy the first car we see, right? We take our time, we compare. Same applies to financial professionals. Same should apply to the bank you choose, the institution you choose. Super important, applying this there. And then, is it rude to ask a financial advisor for reference? I don't think so. I don't think so. I think you're entitled to say, hey, this is going to be what's going to work for me. And you can identify there, the financial advisor says, yeah, let me see what I can do. And then that's someone that is understanding you, right? That's someone that is willing to do that extra step to work with you. So that's a good sign if you want to ask them that, absolutely. Someone who is compassionate, yes. Good communication and listening skills. I love that you brought that up, Wendy, because one thing I want to encourage all of you is to always ask questions, right? Anytime they say something or they use this lingo, you can be like, hey, what does that mean? Right? Sometimes we don't ask because we're afraid of how I'm going to be perceived if I ask a certain question. I believe the right financial professional is going to be there for you and is actually going to be excited to explain things to you, because a good financial professional wants you to understand what's happening, wants you to have some skin in the game. A good financial professional wants to partner with you, not have you depend on them. It's about partnering with someone. It's about that co-pilot and pilot. You are the pilot, right? There are companies where you can say, hey, I don't want to be the pilot. I actually want to leave everything on another person's hands, so my investment portfolio. You can do that if you want to. But I always recommend knowing the basics so that you can have an eye there and you can say, okay, things are doing good, things are not doing good, right? So we're at time. I want to make sure that I cover some of the questions. And before that, let me just briefly, if you can indulge a minute more of your time, just want to tell you what's coming, what's next, right? I'm going to encourage you to finish your financial plan and align goals with budget and balance sheet. Make sure that there's alignment there and you feel excited with each of the items. The other piece, stay organized. Whatever method works for you, that's what we want to stick to. If you want to automate some of these aspects of your finances, I encourage you to use Mint, QuickBooks, or Excel. Those are good options for us to have a platform that helps us have everything organized. We don't have to do this on our own. Automate payments and processes if you can, and have monthly reviews. Very healthy to have monthly reviews. And also start building your financial team. Start looking at all those professionals that you work with as a team, because they ultimately are a team that works for you. And the last, keep learning. Right here at Weave, we're going to be organizing financial empowerment groups, where, like I was sharing earlier, where we're going to invite different professionals so that we can learn from them and learn more about what they do and how they work. So here I want to quickly ask you, if you were to participate, you're going to see the poll in your screen. When would you like to attend future financial empowerment groups? I have some options there for you. Please pick the option that you're like, okay, this works for me the best. So we're thinking about keeping this same time, right? Doing on a Tuesday night, but we also have other options there for you in case anything works. So I just wanted to give you that space to share if you wanted to attend these future financial empowerment groups. Also to ask questions, right? Like think about them also as office hours where you can come in and, hey, I want to know more about financial advisors in the area, or I want to know about how do I more tips to save, right? So things like this. And thank you for sharing. This is very good. It looks like the most popular, it's a Tuesday night at 6 p.m. Thank you. So we'll take that into account. And lastly, before I jump to our Q&A, I just want to say congratulations, right? I want to thank you for investing your time in your financial health, in your financial future. It has been such a pleasure to share all of this with you, learn from you, learn from each other. So I just want to really take the time, celebrate, because we've been spending Tuesday nights together. You've been doing your homework, thinking. I've been giving you a lot of homework. So I'm very, very appreciative of what you're doing. And I know that now you're going to be ambassadors of financial education and share this knowledge with those around you, because this is very important for everyone. Everyone should have access to this information. So I'm so excited to have shared this experience with you. Again, congratulations. You're going to receive a certificate in your inbox. And we're also going to be sharing later on, once we have the dates for our financial empowerment groups, you're going to see that in your email so that you can join us. We're going to do those for free. So we're excited. And thank you so much for your beautiful messages. I'm so happy to see that you learned, and you're also going to get a survey through Zoom so that you can give me your feedback, right? The good and the bad. How can we improve? So I really want to hear from you. And somebody asks, how soon will the financial empowerment group start? We're thinking September. So I'll let you know once I know the dates. I'm going to be looking forward to seeing you all. And I'm, again, just so appreciative of your time. We're going to send the recording as always. We're going to send that tomorrow. And with that said, I'm going to stop the recording so that we can go to Q&A if anybody has some questions.